Welcome to the Robert Hunt Financial Market Update. It's your host, Robert Hunt, where I look at the week's financial news that could be a bit confusing, misleading, and take you off course now to make it actionable, understandable, and clear. It's a new year's episode. 2025 came. Didn't ask our permission. It just came, and we've got some great articles that are going to highlight the year in review and also what we can do on a go-forward basis to help make the news actionable, understandable, and clear. So we're looking at 3 data points, 3 articles. We actually go back in time. I did a little research. The research department at the Robert Hunt Financial Market Update went back and looked at the end of 2023. So we're going to look at an article of impending doom for 2024, where a famous U.S. economist, Harry Dent, predicts a terrible 2024. We then will look at a Wall Street Journal article by Karen Langley, headline Stocks Cap Best 2 Years in a Quarter Century. And then we will enter Robert's Corner, where I will give you a preview into what I am thinking as the year starts, what goes through my mind, what safeguards do I need to keep my cost low, investing simple and time horizon long. So let's start. Mr. Harry Dent. So I went back, used the Google machine, did a article search for 2023, December 1 to December 31, 2023, and I asked it market predictions. And wouldn't you know it, they were all over the place. But one that caught my eye, and this is the Daily Mail, United Kingdom, headlined, U.S. economist makes chilling prediction for 2024, warning of biggest crash in our lifetimes as everything bubble burst. Harry Dent has said 2024 will see the worst crash in our lifetimes, the effects of which will last over a decade. The crash will be driven by overvalued markets and excessive stimulus spending. Dent urged Americans to, quote unquote, get out of the way. Wow. Oftentimes, as an index fund investor, you can wonder, now, is this all too easy? Is this something that I can just do in my sleep? Well, yes and no. Yeah, you can do this in your sleep, but it may not be easy. And here's why. When you ask yourself, how do index fund folks get the returns they get? They pay a price. You and I have to pay a price, and it's the risk, and it's a potential risk that Mr. Harry Dent was right. Now, we can chuckle because it's the end of 2024, and we know good and well the market did not crash. But put yourself just in the shoes of an investor in December of 2023, in your own shoes, perhaps. Listen to what Mr. Dent says. It's all logical, too. He says since 2009, this has been 100% artificial, unprecedented money printing, and deficits. $27 trillion over 15 years, to be exact. It's off the charts, 100% artificial, which means we're in a dangerous state. Huh. All right, well, that all seems right. He's not wrong, is he? And this guy, Mr. Dent, is saying, well, this is good for us. We need this pullback. We need to teach these central banks to not be so cavalier, not be so prodigal in their printing of money, because it's going to ruin everything. Dent predicts, the article explains, that the current bubble bursting will be similar to the Great Depression of the 1920s. He said the roaring 20s bubble was not an everything bubble. This crash is not going to be a correction. It's going to be more in the 29 to 32 level. I'll just, narrator will break in here and say, the market dropped 90% over that time period. From 1929 to 1932, 90% top to bottom. And he explains anybody who sat through that would have shot their stockbroker. Okay, so he's keeping our time horizon long, maybe not. He added, this is the one time I'm telling you, do not listen to your financial advisor. That's me. Things are not going to come back to normal in a few years. We may never see these levels again. Now, let's say you read this in 2023 and folks read people like this. You may have read Mr. Dent, famed economist. It is actually not easy to continue investing year after year when an intelligent person gives you true data and then gives you a clear action plan. So Mr. Dent's saying, don't own stocks. You're going to get smoked. He also said there's a real estate crash. He says, housing prices will drop back to 2012 levels. He says it's a 50% crash for the average house, which went down 34% in the last crash, more than the Great Depression, more than any time in history. This is what's going to hurt people the most. So Mr. Dent is warning you, there are all sorts of problems. I suppose he wants you to buy bonds. This is why investing, and more particularly index fund investing, is not a free lunch. Because you know what? It's possible that in December of 2023, he was right. It very well could have been a 90% drawdown. There's no rule that says that can't happen. It happened before in history. Why couldn't it happen again? Now, I've got all sorts of reasons why it's probable it won't happen again. But that return premium, the reason why you earn more than U.S. Treasuries, the 10-year U.S. Treasury as an index fund investor, is because you do risk. Although I'll say it's a small risk, you certainly do risk. It is possible for a 90% drawdown. Every single year you invest in the stock market or stay invested in the stock market, you have to know that is a possibility. And you have to keep investing despite that. Now, you may be asking, if I had had a podcast, which would have just been a radio broadcast in 1929, and I was singing my Cost Low, Investing Simple, Time Horizon Long, I would have had to produce every week a podcast from 1929 all the way until 1954. Because that's when, if you timed it really poorly, like you put all your cash in the very top in 1929, you would have had to wait that long. That would have been a lot of tough podcast episodes. I may have lost a few listeners in that time period. So that's the risk you're taking. And I think you got to stick with it. And I think you do too. Each year we push, and I'm setting you up because I'm going to give you some warnings that other people are giving now. Oh, guess what? It's the end of 2024, beginning of 2025. What are the new warnings we're going to have to ignore? Well, they also sound pretty compelling, just like Mr. Dent's was. But we're going to keep moving on. I'll look back here. Wall Street Journal, Karen Langley, stocks cap best 2 years in a quarter century. I'll read that again. Stocks, she's referring to the S&P 500, the 500 American companies that are representative of the American economy. They kept the best 2 years in the last 25 years. Wow. Sub-headline, of course, some investors caution against thinking that the rapid pace of gains can continue because interest rates may remain higher than anticipated. Okay. Why is that, by the way, listener? Why is it that higher interest rates oftentimes portend lower stock market returns? It's because money is a roving predator looking for high returns. So it's always seeking out a high return. And if it can get it in U.S. Treasuries at a lower risk, if it can get 4 or 5%, why would it risk that 90% drawdown that I referenced? Why would you do that? But listen to this. Year in review, the S&P 500 climbed 23%, notching 57 record closes as the economy remained healthy, inflation ticked lower, and an AI-fueled rally in big tech stocks powered on. So we just had the best consecutive years since 1997 and 1998. Okay, now this is where they're going to try to scare you. Those 2 years led up to the bursting of the dot-com bubble. But does it feel like that? Does this feel like the crazy late 90s for the listeners that remember it? It doesn't really to me. I guess in the midst of it, when you're experiencing it, it doesn't always seem that great. But other asset classes have done well too. Gold has its best year since 2010. The article explains Bitcoin doubled, vaulting above $100,000 for a little bit. And all the while, interest rates have held up. The S&P 500 traded late last week. The article explains at 21.9 times its projected earnings over the next 12 months, above its 10-year average of 18.5 times. So that's data, listener, that would make people go, ooh, a little frothy. Maybe we need to dial back. Maybe we go buy some more bonds. I don't think so. We don't know. Whenever someone lists a 10-year average, it's of course interesting data. We have no idea if it's actionable. Because what they're saying without saying this in an article, this is FactSet gave the data, does it mean anything? I don't know. We'll know if it means something another 10 years from now. We don't know. We don't know if this past 10 years average of 18.5 was actually a meaningful anchor. You've heard the phrase perhaps reversion to the mean. Reversion to what mean? The historic mean? Well, that may not mean a whole lot. No pun intended. No pun intended. We have no idea what an appropriate price to earnings ratio will be over the next 10 years because there's a whole lot that can happen. It may be that the stock market is appropriately priced. I was talking to a friend and they were asking me, what do you think of the stock market? What are your predictions? Of course, I demur and give my ho-hum, cost low, investing simple, time rise long. But I said, but let's play devil's advocate. Can the stock market go high? Is it cheap? Is it expensive right now? And I basically, the market could be fairly priced. In fact, as an efficient market theorist, I think it's always fairly priced. But if AI and earnings growth continues, it could be cheap. It could be cheap. This very well could be one of the greatest entrance points in American stocks in your lifetime. It could be the very worst entrance points of American stocks in your lifetime. We don't know. I don't know. No one knows. We can control our cost. Very tough to control a whole lot else. Your time horizon, yes, I can do that. The complexity of your investments, I can control that. The price to earnings ratio, the forward price to earnings ratio, the mean price to earnings ratio for the previous 10 years, and that's how many dollars do you pay per dollar of earnings. So the higher the price to earnings ratio, the more expensive, so we think, the stock market is, and the lower the price to earnings ratio, the cheaper the stock market is, so we think. But it's not as simple as buying a gallon of milk at the store, that price to earnings ratio. There's a whole lot that goes into it. As a long-term investor, I don't think we need to anchor to it or focus on it. It's interesting data, but not worth focusing on. So I think it's okay, listener, to pat yourselves on the back if, in fact, you held through Mr. Harry Dent's prediction of doom, you held through continue to invest in these high price to earnings ratio markets. Pat yourself on the back. You were tough. You had resilience. There is no free lunch for the people that say, oh, you index fund people, you're so lazy. Just layabouts, just letting the index fund do the work for you. Hardly. If it was this easy, Harvard and all the rest of the endowments would beat the index. But they don't. Nothing easy about it. Takes humility, fortitude, thick skin, all these things. So stick with it. And then enter into Robert's Corner. Bring the children around. I'm sure we have a whole host of New Year's resolutions, a whole host of them. 2025 comes around, January comes around. Sometimes the gym membership surges, the hourly financial advisor membership surges. We're all ready to get back into it. What am I thinking about? What do I do for 2025? What's on my mind? Well, probably the stuff that's on your mind. I'm looking at all the same data you are. One of the things I saw on X, people are pushing the typical 10-year returns when the S&P 500 has a forward price to earnings ratio where it is today. So I just explained what that price to earnings ratio is, that how many dollars it takes per dollar of earnings in these companies. The higher, the potentially more expensive, the lower, the potentially cheaper. Well, we're at a spot where all the maps show 0% returns for U.S. stocks. We're looking at Goldman Sachs and the Vanguard Group predicting modest returns in U.S. stocks for the next decade. I got an advertisement in the mail. Sometimes as a financial advisor, they ask us to pitch mutual funds, and they're pitching me on an active fund because of the Buffett indicator. So this is the S&P 500 market cap as a percentage of the gross domestic product. Now, don't expect you to know what that means, but Warren Buffett uses it as a way to determine if the market is overpriced, underpriced, and it's as high as it's ever been since 2000 based on the chart they sent me. So these people are, Catalyst Funds, it says, are selling me on, hey, don't just invest in the index. Go ahead and buy our product that it's going to help you zig and zag and zog and get out of this mess. They're predicting, they're saying the data shows the S&P 500 10-year returns average negative 2.75% annualized every year following valuations like we had in November of 2024. Are you scared yet, investor? Are you afraid? Are you scared, Mav? Are you afraid? Are you scared, investor? Are you afraid? I kind of understand why you would be, and I totally get it. I think this would be most terrifying for the investor that just sold a business or a house or whatever, is in all cash and is thinking, hey, it's time to invest. My advice to that investor is put the blindfold on and click the button. The worst thing to do is to start going down the rabbit hole of all CAPE ratios, Case-Shiller ratios, forward PEs, cyclically adjusted PEs, all this gobbledygook. You know what it'll do? It'll convince you never to invest. So what do? You might be asking, what's the punchline? Let me tell you. Because I am a born market timer, and I think most of us are, it appears rational to invest when the market's cheap and to sell or not invest when the market's expensive. What do I have to do? I have to set up rules for myself. Your podcaster, your advisor from the speakers struggles enough with market timing, and because I love the details, I love learning about all this, that I have to set up a rule that says every January I have to invest. No matter what. All-time highs, all-time lows. Harry Dent tells me it's over. Goldman Sachs says it's flat for the next decade. Yada, yada, yada. I have to put on my blindfold like an ostrich, stick my head in the sand, and click the button like a Luddite. Got to do it. Now, that has helped me do is not play the game, because it is so tempting to play the game. I know that doesn't mean, and this is where I will invest in international stocks instead of U.S. as a balancing tool, not a market timing tool, to ensure that I have sufficient international stocks. But oftentimes a good New Year's goal can be a personal investment statement. And it can be written, or you can know it in your heart, but just have a couple simple rules. And it may be enough to say, I'm only going to do index funds. I'm only going to, you may just do them in your 401k, auto invest. Forget the January rule. You don't have to. You get a 401k. You're auto debiting from your payroll. Beautiful. That's great. But set up a couple rules to override some of your instincts. We've met the enemy, and it is us in investing. When we look in the mirror, that's usually the greatest risk to our investing is the person we see in that mirror. It's us. Set up a couple rules. Get yourself out of the casino, and keep those costs low. That investing simple on that time horizon long, because that's what's going to give you the best shot on your investing journey. Until next time.